Welcome everybody to the options module. This is going to be a very informative and potentially a little overwhelming, so do not feel upset if this seems a little confusing at first. I will make sure by the time you're done with this module, you are going to be an options pro. First, what is an options contract? An options contract is a piece of paper that is worth 100 shares of the underlying company. The contract, or the 100 shares, gives the holder the right, but not the obligation, to sell or buy the underlying stock at a given price. This is known as the strike price, which expires at a certain date called the expiration. So why trade options? Well, options allow you to trade volatile, expensive stocks for very minimal capital. For example, you can trade a stock that's trading at $600 for as little as $30, $15, maybe even $10, depending on the contract. And with these low prices, you can then have exponential returns of over 300 to 500% or more on ideal setups. Now, what makes an options contract different than just buying the stock is that the option contracts you purchase can expire. Because of this, contracts have a framework that are built around them. The terms that make up this framework is the strike price, expiration date, implied volatility, and open interest. They also have certain terms in regards to how you can purchase the options contract, which will be labeled as calls or puts. Now let's break down the vocabulary of options. Let's start with calls. When you purchase a call, you're expecting the stock to rise. And as such, if the stock does increase, so will the value of your options contract. Conversely, when you purchase a put, you're expecting the stock price to fall. And as such, if the stock price does indeed decrease, then the value of your options contract will actually increase. This is the main difference between calls and puts. Calls, you expect the stock to go up, where puts, you expect the stock to go down. Playing puts is also a great alternative to investors who want to short sell large cap stocks because it limits your risk to just your initial investment and not the unlimited risk potential by traditional short selling. Now, let's talk strike price. The strike price represents the price of the underlying stock you are trying to trade. Let's dive into a real life example so I can show you exactly what I mean by this.
All right, you guys. So as you can see here, I have Tesla pulled up, and on the right-hand side is the actual chart of Tesla. So this is where the stock is actually trading. This is the common stock chart. On the left, you will see the options chain. So this is where you'll trade options. Now, for this example, you'll see these numbers right here in the middle. And right there, you see the name strike price. So these are based off of where the stock is trading. So as we can see, the stock is trading at 674, and you'll see that these options are either below or above that price. So the numbers below for the calls are going to be what's considered in the money. If they are above, they'll be out of the money for puts. So if I wanted to buy an option contract that is out of the money, I would buy one of the higher price strike prices, 685, 682, 680, whichever one I want. If I think the stock is going to go down and I want to buy a cheaper option on the puts, I would buy one that's lower than where the current price of the stock is. So 672, 670.
All right, so to recap everything, the strike price represents whether or not your options contract has any actual value or not. If you buy a call option and the stock price is higher than the strike price, your contract is now considered in the money. If you buy put options and the stock price is below your strike price, the contract is now in the money. Now, if the stock price is outside of your strike price, then the contract is going to be considered out of the money. So, if the stock is lower than the strike price on calls, your calls will now be considered out of the money. However, if the price is above your strike price on puts, those would be considered out of the money for the puts. So, what exactly is in and out of the money? In the money means if you were to hold the option till it expires, then you could cash in your option for 100 shares of the underlying stock at the strike price you bought the contract. And that's why we say it has intrinsic value, because if the option expires, you are able to cash that option in for shares of the underlying company. Out of the money means if you were to hold the option till it expires, then your option would expire worthless. That's right, a big fat zero, or in other words, it has no intrinsic value. So you may be asking yourself, if options only have real value if they are in the money, then how come you can still trade strike prices outside of the money? And what gives them value? Well, the answer to that is time premium. Time premium is the cost you pay to own the contract based on the time it has left to expire. You will notice if you try to buy an option contract that expires in 7 days, it will be cheaper than the exact same option expiring a month later. The reason for this is that there is a greater chance the stock will reach that strike price the further out you set the expiration. And for that extra protection, you are forced to pay more premium for that time. We will discuss time premium more when we talk about the Greeks, but for now, just understand that options will lose value over time the closer they get to their expiration, because that time premium, or time till expiration, is decreasing. Also, that options out of the money have absolutely no intrinsic value and are made up completely out of time premium. That means if that stock does not reach the strike price, you're going to continue to lose more and more value out of that option. Now let's explain a little bit about expirations. Option expirations are broken down as follows. They go by monthly, weekly, and daily. Monthly contracts always expire on the third Friday of the month, usually on stocks with lower volume. Weekly option contracts expire on the Friday of the respective week, and it only applies to heavily traded large caps such as Apple, Amazon, Google, Tesla, etc. Daily option contracts only apply to overall market indexes and expire on exact dates specified. A good example of this would be the SPY. All right, so before we wrap up, let's talk about implied volatility and open interest. Implied volatility is a calculation of how much an option's underlying stock price will change before the contract expiration. Stocks with low implied volatility aren't expected to fluctuate dramatically before the options expire. Conversely, stocks with high implied volatility are expected to increase or decrease in value, sometimes both, during the period covered by the options contract. It's important to note that IV fluctuates based on investor sentiment on a particular stock. If investors feel a stock should perform well or expect large positive price movements, then the IV will generally increase. However, if sentiment is flat or negative, then IV value usually goes down. IV is also important because of its relationship with the Greek vega, which we will go over in a later video. Now let's talk about open interest. Open interest is a number of active contracts. These are contracts which have been purchased but not yet exercised or sold. So if you were to buy 10 calls from Apple, that purchase would add 10 to the open interest figure. So if you wanted to go out of your position, you would sell those same contracts to close. Option interest would then fall by 10. So if the open interest was at 100 and you bought 10 shares, now the new open interest would be 110. If it was at 110 and then you sold those 10 shares without any other people trading, that open interest would now be 100. Open interest is generally used by investors to get an idea on how ideal the spreads will be for the given contract. In general, a contract with a high open interest will have better spreads compared to an option with lower open interest. You can also compare the volume on a day to the amount of open interest to try and gauge overall trader sentiment. If there's a large amount of interest and large volume, that means there's a lot of people buying the stock and holding, which means depending on whether it's a call or a put, is showing how much those traders believe the stock will go one way or the other. Finally, let's talk commissions. Now, commissions will vary from broker to broker, and it's extremely important you call your broker to negotiate for cheaper fees. Most brokers for new accounts will automatically charge you the max, which could result in you paying up to $20 per options trade. The best way to negotiate with your broker is to tell them that you will be an active trader and making lots of trades. I usually say that I'll be trading over 100 option trades a month. Now, if you are an experienced trader and have been trading a while, you can use your trading history to leverage your broker for better fees. I highly recommend, if you're going to only be trading options, you call multiple brokers and see who can get you the best deal. Because believe me, these commissions add up. That was a lot of information. If you're feeling a little overwhelmed, don't worry. We are going to continue to break down these concepts in the following videos. But by now, you should have a general concept of what options are, and in the next video, I'm going to show you how to buy them.